Jamie Dimon, great to see you. Thank you so much for sitting down with us.
Yeah, thrilled to be here.
Yeah, I want to get your take. The largest bank, you've got so much exposure to the consumer and to housing as well as to commercial and business. How would you characterize the economy right now? Give us your sense of the macro story.
Well, it's pretty good, which you all your viewers know is that the economy is growing at 2%, unemployment's low, 4.3%, wages not going up that much anymore. Corporate debt's not that high, consumer debt's actually not that high. Inflation is ticking up. That's not good. And you have a lot of stimulus. The one big beautiful bill, $300 billion of stimulus. The additional spending AI is $300 billion of stimulus. Dereg, it's a form of good stimulus because it allows people to put their money to work in a better way.
So for a quick context, because this one matters, that's Jamie Dimon that everyone knows. You know him. CEO of JPMorgan, the biggest bank in America today. And here's the key. Dimon is not a MAGA guy. He is the Wall Street establishment, a critic of both parties. So when he's asked about the economy and he says it's going pretty good, that lands differently than a Fox toss saying it. And listen to what he credits. The big, beautiful bill. Deregulation. He calls them stimulus that is actually working. When the establishment validates your side's policy, that is worth stopping on. Watch how this plays out.
And so those things are good. And a lot of that, but we have a huge deficit, and that's kind of stimulus that also ends up in corporate profits. So corporate profits, are up huge this year. So people are feeling good. Stock prices are up. That's all good. And there may be negatives. I think the one that you can see a little bit is inflation going up.
Yeah. Have you seen inflation cutting into consumers' ability to actually spend? Are they cutting into their savings?
Yes. I think, you got to separate consumers into various segments. For the high end, it doesn't do anything. And if you take the higher gas prices, $1 of gas is $100 billion a year. But of course, it affects lower income folks much more. And for them, they have to cut back something else or do something. So what has happened for some is they have cut savings and they still spend. And, and borrowing is going up just a little bit. So it might be that. It might not be sustainable forever, and we don't know what's going to happen with future gas prices. So you do have a little bit of that.
And in terms of the big, beautiful bill that you just mentioned, are you seeing companies increasingly use things like the expensing, the expensing options that were in that bill? Because you can write off so much right now.
No, it's expensing options. It's the R&D credits. It's a competitive tax. I think, we need a competitive tax structure globally, and this is competitive globally. And so that puts American companies in a position where they're going to invest here or elsewhere. There's an incentive to do it here, too. Or at least not a disincentive to do it here and an incentive to do it elsewhere. Before taxes were cut, and this happened in Trump's first term, you had huge sums of money going overseas and staying there because, the returns were so much lower if you could do exactly the same equivalent behavior. So that does matter.
Now, two things here. Dimon does flag inflation, mostly gas prices hitting working families, and give him credit for being straight about it. That's the watch item. But then comes the part conservatives have argued forever. He says the competitive tax structure, the expensing, and the R&D credits is keeping American companies investing here onshore instead of shipping the money overseas. That's the reshoring case confirmed by the biggest banker in the country. So let me ask you, are you feeling the stronger economy where you live? Or are gas prices still biting? Drop it in the comment section. I'll read them all.
So you feel good about where we are now in the economy, even though inflation is ticking up?
Yeah, I feel okay. I'm a little more worried about other people. Now, you see, it's not their immediate cracks in the economy. It's the other things I worry about that has a long list of serious issues that are going to have to be dealt with. I don't know how they're going to affect the economy this year. You can't put them in a base forecast. They are large items. I always refer to them as tectonic plates moving around that may cause issues that we don't fully understand today.
I mean, it's interesting because this market has been in a melt-up, right? Look at these major averages since the end of March. Are you surprised to see things like the NASDAQ up 28% in the last 2 months, even in the face of two wars that we're watching play out?
I'm not surprised, other than in the face of two wars, that they don't seem to have derailed anything. But you and I have seen this before, where you have these kind of melt-ups, and you often go on longer than you think. So, the person says, that's too much. Well, maybe not, because they can go on for a long time before something reverses them. And you don't know what that is. It could be sentiment, it could be inflation, it could be higher rates, it could be business sentiment. Obviously consumer demand, if it drops, that, a lot of companies will cut back inventory and the profits will drop and all that. So it's always a confluence of events. Very hard to predict in the next 12 months what's going to happen. And I actually think it's a huge intellectual error to say, here's my base case. What I always look at is, what's the range of outcomes? You could put probabilities of those outcomes. My probabilities of a worse outcome are higher than other people's. And it's mostly around inflation driven by multiple factors.
Yeah, but I think the other day you made some news at the Bernstein conference. You said you were cautiously pessimistic.
Yes, I know. I was kind of joking because everyone says cautiously optimistic.
And here is the headline for the booming part. Dimon points to a market that is melting up. The Nasdaq up 28% in just 2 months. And it has not even been derailed by 2 wars. I mean, that's strength. Now, he plays it very careful, though. He calls himself cautiously pessimistic and warns, these runs go longer than you think before they turn. I mean, that's smart, but notice what he's not saying. He's not calling a crash. He's saying the economy is strong right now. That is the honest read. And right now, the read is good.
Okay. So cautiously pessimistic. The other thing you said, which I thought was interesting, is you tend to buy back your stock all the time, but you said you're not fond of buying back the stock of JPMorgan at these levels.
I have been very consistent. We are buying back the stock at these levels. I prefer to buy them at lower levels. I prefer to help my existing shareholder, not my leaving shareholder. And we've always believed that investing in our company is better than buying back the stock. However, we have a lot of excess capital, and the stock is, you can call it equilibrium, but I don't like equilibrium. I like to buy it when I think it's kind of cheap and it's a bargain. So Warren Buffett says the same thing, and so do a lot of people. Buying it automatically, I think it's just an intellectual fault. That's not you should be buying it. If stock price go from here to here, you buy more here and less here. And that's kind of what we do.
So it's the most fundamental thing you learn on Wall Street: buy low, sell high.
Exactly. And then it takes judgment, what that is. And it's hard to fight the market. The market says the stock's worth X. Well, it is probably.
Yeah.
But that doesn't mean I want to buy at that price, particularly when I think I can use my capital. That's the other thing I probably mentioned at the conference, is that we have all this excess capital, we estimate about $40 billion. I believe now that we can deploy it in our businesses over time. It may take a couple of years because of things like SRI, and I'd rather do that. So if I had no other options, then maybe it'd be more stock buyback.
Yeah, you're talking about your security initiative, and I'm going to get to that in a moment, because you also said, just as you were saying, that JPMorgan is earning 20% as opposed to your target of 17% in terms of a return on tangible common equity. You said that you personally think that you're over-earning. The entire industry is over-earning.
I didn't say the industry. I said us. It just means when you have, our business always has volumes that go high to low, okay? Credit losses that go high to low. Credit losses are kind of normalized. Volumes are quite high. Exuberance is quite high. Profits are made at the margin. The next trade is more profitable than the average trade. And people sometimes forget that. And so I have a little humility, because look at what happens. In 120 company years, between the last 10 years, how many companies earned over 17% in banking? Or earned over 17%. It was like literally 8% of the time. So to think it's going to go on forever is a mistake. It's a competitive world. It's a capitalist world. As Jeff Bezos says, your margin is my opportunity. And we have a lot of competition. And they're coming, and they're smart. I recognize that. And they've done very well. And the base competition is quite good. They're all back. It's not like anyone's weak anymore. And you see that in the numbers. So I just think we should be a little cautious about bragging about our results.
So trading volume is abnormally high right now?
It is high, and values are high. So remember, values drive a lot of things: custody, treasury, deposits, asset prices going up. And so all these things drive a lot of things. And if you model it through, there's another side of that mountain sometimes. And I don't know when that's going to happen. I just think eventually something will happen, and volumes will go down. There'll be a little recession, credit losses will go up, and we'll still be doing fine. And I think actually that's when you perform. It's really important to perform in bad times, not just in good times.
Now, I'm wondering if the Federal Reserve changes is going to be a catalyst for those changes. What's your take on Kevin Warsh and how he's going to approach his new job as chairman of the Fed?
I think the world of Kevin. He's quite experienced in this field, in all fields. He's been in the central bank before. He obviously knows global markets. And I like what he says, which is, the Fed should focus more on the financial system and not so much regulatory. He's right to say, after all these years, rule after rule around the world. I mean, Basel III has been 10 years in the making. So is this what we wanted? What was the outcome? Can we make it better? I actually think you can make regulations simpler, less costly, get more loans out there, and make the system better and safer. And I think that should be the goal. And so I hope they do that. And then, rates, I don't know. Remember, he's going to walk in a room with 12 other governors. And so he has his ideas. He's a smart guy, but he's got to give them time to think about it, do some research and all that. So.
And so to close it out, even on his own bank, Dimon preaches humility. He says JP Morgan is over-earning and the competition is coming. And watch his take on the new Fed chair, Kevin Warsh. He likes that Warsh wants simpler rules and more lending instead of endless regulation. That's the deregulation argument again, straight from Wall Street. So here is the bottom line. The economy is strong. The pro-growth agenda is delivering. And even the cautious banker cannot deny it. If you want the news told straight and not spun, hit subscribe. It genuinely helps. See you in the next one.